From a consumer perspective, I think it's inevitable that that's where we're shifting. And the reality is that banks need to do an increasingly good job of cross-selling through digital channels and upselling through digital channels to offset what they're losing in branch face-to-face interactions.
Hey gang, it's Tuesday, June 29th. Dan and listeners, welcome to the Behind the Numbers Daily, an eMarketer podcast made possible by VTEX. I'm Marcus, and today I'm joined by our VP of Content and Head of Financial Services. It's Dan Van Dyke.
Hey, thanks for having me.
Hey chap, thank you so much for joining us. We start, of course, with the fact of the day. Roundabouts, or traffic circles, as you American people call them, are safer than regular intersections. So in the US, roundabouts, or those traffic circles, are pretty rare. The reason Europeans use them so much is because they promote safety. A four-way intersection offers 56 potential points of conflict. That is chances for you to hit a pedestrian or another car. 56 opportunities. Opportunity is a bad word. Potential points of conflict. A roundabout reduces that number to 16. So from 56 potential points of conflict to 16. They do require drivers to slow down, but since a traffic light requires stopping on red a large portion of the time, roundabouts actually allow for faster travel as well. That was from Tom Vanderbilt, author of Why We Drive the Way We Do and What It Says About Us. I hope driving the way I drive doesn't say much about me, because I am a very different human. Do you come across many roundabouts or traffic circles over here in the States, Dan?
I have to say I don't. I no longer drive, but I would tend to agree that the way I drive them, they're probably not safer. But just because there's so few of them around here.
Yep. It took me about 3 years to realize stop signs existed. I was definitely running through every one of them until like 3 years later. I was like, what's that thing? And people are like, you're supposed to stop. That's when you stop.
It's more of a suggestion, It's the rolling stop.
I'm with you. Anyway, today's topic, what does a world with fewer banks look like? Okay, so as The Economist notes, it's hard to imagine a world without physical banks. They're where we go to pay people, do some of the more complicated banking stuff, buy a house, take out a loan, and their logos are everywhere, from the tops of the tallest skyscrapers to the end of every strip mall down every high street. Dan, I said today's topic is about what a world with fewer banks looks like. What we mean by that is fewer bank branches, right? And the shift to online banking.
Yeah, I mean, I think both are playing out, but certainly the topic of discussion is the bank branch, and it gets a lot of polarized responses. On the one hand, you have the sort of sensational headlines, the death of the branch, and you reference the Economist headline there too. On the other, I think you get sort of the cold water response, which is, no, the branch isn't dying immediately tomorrow. And in between that is the nuance where it starts to get interesting. And we have some perspectives on what's going to happen there too.
Mm-hmm. Yeah, you're right, because the headlines, I was thinking, I better get to the branch quick and get one more shot of the experience because it's going away. And then I started looking at the FDIC data, 2012, there were nearly 100,000 US bank branches. 2019, 86,000. So they're definitely going down, but they're definitely not disappearing. And then we have some numbers on visits, bank branch visits. Visits are also down. 2012, about 85% of Americans who have a bank account, 85% who have a bank account visited a branch. Today, 70 do. So it's from 85 to 70 in roughly the last decade. Next year, 68% will still visit a bank branch. By 2025, 65% of the banking population will still visit branches. What do these numbers say to you, Dan? What's going on?
I think, the interesting question is most bankers would acknowledge that branch usage is trending down, and COVID has accelerated that to an extent. The question is, what do providers do with these multi-billion-dollar investments they made in building out their branch network? And I think that we're looking at as you mentioned, sort of a steady trickle of branch losses, at least in the US. The UK is a little bit quicker. I believe that it's going to turn into a stream, but it's not going to be a torrent. So by that, I mean, it's not going to be something like the collapse of Blockbuster, where they went from peak Blockbuster in 2004 to basically bankrupt in almost no locations in the course of 6 years.
Yep.
And so to back up and sort of set the stage, you mentioned some statistics looking back about total branch penetration and where we were back in 2012. We were seeing up until that peak that you referenced, really rapid growth over multiple years. And to put the number that you referenced, 100,000 in comparison, in the US, there are 110,000 libraries. So pretty ubiquitous across the country, arguably a little bit more than we need just in square footage alone. And of course, the turning point that we saw back in 2008, 2009 was the financial collapse, resulting consolidation, profitability challenges, digitization, swallowing up in-person interactions. So sort of like a perfect storm. And underpinning that, we have the growth of mobile. 2007 was the year that the iPhone was first introduced. So we've been losing these branches at a trickle, 1.5%, now 2% year over year declines. But as you mentioned, today we have over 80,000 branches in the US. Right. And if this current rate holds, by 2030, we're still going to have about 70K. That's right. Projecting out like 2% right. year over year losses, which would be double the amount of supermarkets in the US.
Wow.
But the question is that going to hold that growth rate? Or is it going to be sort of a gradually then suddenly phenomenon where the trickle of losses turns into a stream? And I would have to say, I do believe it's going to turn into a stream.
Huh. So, yeah, it seems almost like kind of comparable to the death, quote unquote, of cable. It's still 57 to 60% of households still have cable, despite all the headlines of cord cutting. I guess it's also worth noting that our definition is pretty generous in terms of frequency, right? Visit a bank, credit union, or a brokerage branch and see a representative in person at least once a year. So interesting to see some frequency numbers. People maybe used to go, I don't know, 50 times a year. Now they go 25 times a year, perhaps. But I'm also wondering what's going to happen to the branches which were temporarily shut. Research analyst at Insider Intelligence Matthew Gahn wrote back in March that, quote, up to 30% of branches temporarily shuttered in response to the pandemic may never reopen. He was citing a former retail distribution executive at Bank of America, Rob Allback. Does that seem reasonable to you? Do you see like a lot of those branches that temporarily shut down going away forever?
It's hard to say. And the reason being, I know that's a hedged response and it's kind of boring, is that there is some regulatory uncertainty. So the Office of the Comptroller of the Currency throughout the coronavirus crisis sort of commanded banks or, suggested that they not use the coronavirus crisis to accelerate ongoing branch losses in the US. That said, we have seen certain banks, for instance, Wells Fargo, continue to shed branches. I don't believe that the number will be exactly as high as 30%. It could go up to that. I think nonetheless, we will see some sort of accelerant trend of COVID increasing already ongoing branch losses in the US. When I say accelerant, I mentioned before, we're seeing 2% year over year losses. A rapid acceleration on that would be an increase to like 3% year over year. And if you project that forward, the effects of that could be really profound in moving away from the 70K that we would see at 2030, according to a 2% year over year drop, would probably move at 10K, but I can't do that math in my head.
Who can? I was really fascinated to see. So, as you mentioned, the acting head of the Office of the Comptroller of the Currency saying to banks not to use the pandemic, as you mentioned, as a reason to accelerate branch closures. How much control do they have on how much banks can close down branches?
Well, it's a regulatory patchwork. I don't think there's a clear, easy answer to that question because, as you know, in the US, there are multiple competing regulators that each have influence, either regionally or nationally, over how banks operate digitally and physically. And what's often framed as a suggestion may be anything but. And it's up to people who are more specialized in unpacking regulation to be able to say which is really a suggestion and which is more of a command.
Right. All right, let's take a quick break for a word from our sponsor, VTEX, and then we'll be right back with the rest of the conversation. Retail's next competitive threat may come from a business model or channel that didn't even exist a few months ago. This modern dynamic requires companies to adapt quickly, pivoting business seemingly overnight, something traditional commerce platforms just can't support. There's a new enterprise commerce platform on the rise, one that's fast, flexible, and doesn't require 9 months and $1 million to get up and running. Go to vtex.com/eMarketer to learn more. All right, we are back the other side of the break, continuing to talk about what a world with fewer banks looks like. So, as we mentioned, the number of branches is going down. It's definitely not disappearing, but it is going down steadily. However, not for every bank. Insider banking analyst Tom Octoloni recently noted that Bank of America is bucking the branch closure trend. He writes, opening a handful in Kentucky. Dan, what's going on here? Surprising that Bank of America are opening branches?
I think it speaks to an interesting phenomenon, which is that bucking the overarching trends of ongoing branch losses, there are a couple of banks that are continuing to open up new ones. I think it's important to put that in context. So for instance, Bank of America, the news story that you're referencing is that they're opening up 4 branches in Kentucky. They've also closed 1,500 since 2009. So the overarching trends is that they're shedding branches. Other banks like Chase are planning to open up 400 branches. So that's a $20 billion investment, very substantial over a period of 5 years. And the question is, why would somebody like Chase do that? And on a specific level, specific to the top 5 banks, I think you can look at consolidation that's happening among the top 5 providers and say, yes, the overall pie, meaning total branches in the US, is contracting, but the slice of the pie that the top 5 banks continues to expand. So it's only natural that some of them would continue to open up branches, despite that being a channel that consumers on the whole are drifting away from. And generally, to broaden that to why would a bank today open up branches, period, big or small, I think there are a few compelling reasons. And some of them tie back actually to the analogy that you used about cable, in that there are older customer segments who still rely on branches or other human-centric channels and prefer those over all others. And they're not going to age out of the financial mainstream very quickly. 2 is, if you look at what drives deposit growth, since I think a lot of the conversation so far is centered on maybe impliedly customer interactions and where you go to deposit a check or check your balances, etc. If you think about sales, branches are where you're driving the vast majority of that deposit growth at most banks today. It's still a powerful channel to deliver advice, to cross-sell, to upsell, especially complicated, high-value services that represent the long tail that hasn't translated into digital interaction so far. And until digital is going to serve as a proxy for selling to the same extent as physical channels, I think, we're still going to see enduring value for branches, and that will drive other banks besides just Chase to continue to open them up.
Yeah, there was one of the articles from Insider Intelligence I was reading was saying branches being used for more of those complex financial activities as you were talking about, and they were citing the worldwide research from KPMG, noting that folks saying that they're likely to visit branches less to check balances, but visit them with the same frequency when inquiring about new products or purchasing those high value ones. So there's definitely certain reasons that you do things digitally and certain reasons why you still go into a branch. How are branches changing? The ones that are still around, what is this new branch going to look like?
So I'm based in Brooklyn, as we were talking about earlier today. And if you walk directly down to the water from my apartment, you'll run into a cafe branch. And it's something that Santander set up as a sort of concept where they're offering things like coffee. Most of the appointments are actually set in advance using digital tools like your mobile device. This represents a broader theme of reimagining what a branch could be. On the one hand, you have some far out there concepts. I mentioned the Santander example. There's also Capital One, who sort of pioneers this idea of a quasi gathering place / cafe / branch. On the other hand, I think you're also seeing the modularization of branches. you can fit more interactions into smaller and smaller physical footprints and thereby, derive the same benefits as having a branch without incurring the same cost. And in doing so, I think you can make sure that the ROI of opening up branches remains consistent even as you contract your overall footprint. So there is that digitization taking place, and there's a lot of interesting innovation happening with branches.
Yeah, one of the articles from Insider Intelligence research analyst Rachel Green was saying that banks can save between 600K to 800K per branch, which is a remarkable amount of money to be able to save annually. So yeah, there's definitely benefits for banks to not have them and cost savings. I like this idea of blending digital tools into physical branches. And Mr. Gon had a couple of examples there. He gives the example of the UK bank NatWest letting customers use its app to join a virtual line for an appointment, freeing them of the need to actually wait in line. And then in 2019, he says, another example, Chase added enhanced ATMs capable of handling 80% of teller transactions and equipped employees with tablets to roam around the branch to help clients. Also, the article by Miss Green from Insider Intelligence saying back in November 2020, another example of how banks at least changed because of the pandemic, saying some smaller banks were only serving customers by appointment or via drive-throughs. What do you make of some of these innovations, either ones that predate the pandemic or pandemic-related ones?
I think from the customer experience perspective, it can only be framed as a positive. From a purely analyticals dollar and cents perspective, there are some drawbacks to actually decreasing friction in the branch. When you think about the ideal time that a consumer spends in a branch, typically a bank thinks about it as they want you to spend some time in line. It doesn't sound great, but it's the reality of it because they want a teller to come up to you, ask you some questions, potentially cross-sell you some services that you weren't expecting to come into the branch to be sold. And by setting appointments, I think one, you can increase foot traffic, and that can allow you to decrease the amount of staff that you have that can handle a particular branch. And that in turn can decrease costs. But what you're losing out is the opportunity to sporadically, drive revenue and cross-sell in the branch too. So there's pros and cons that come with that from the bank perspective. From a consumer perspective, I think it's inevitable that that's where we're shifting. And the reality is that banks need to do an increasingly good job of cross-selling through digital channels and upselling through digital channels to offset what they're losing in branch face-to-face interactions.
So only 9% of American adults, just 9%, said the coronavirus pandemic had been very inconvenient when it came to trying to conduct banking activities, according to JD Power May 2020 survey. 35% hadn't been to a branch lately anyway, so they weren't inconvenienced by it that much. 23% of folks said their bank offered other easy ways to bank, so that helped tremendously. Dan, what did the pandemic do to digital banking adoption?
I mean, unsurprisingly, it grew it. So I think pre-pandemic 2019, you were looking at 67% adoption according to our forecasts. And that's since in 2 years risen to 75%, which is much, much faster adoption growth than we've seen in previous years. It was starting to level off. I think that's one stark trend that has emerged from this that stands out first and foremost.
Yeah. I was surprised that it was as high as it was pre-pandemic. 67% surprised me to see it there. But as you note, it went from 67 to 73 in 1 year. And then this year will jump up to 75% of Americans using digital banking. By age is very interesting as well, as disparities like every other thing that we cover. 85% of those younger than 45 use digital banking. Over 85% of those younger than 45 use digital banking. Half of those 65 plus. And it seems that they're doing those old, let's call them traditional things in new digital ways. Qualtrics found that the most likely digital banking activity carried out was checking account balances, 46%, depositing a check, 40%, and paying someone or transferring funds, 34%. So aside from those examples we gave at the a little bit earlier in terms of letting customers join a virtual line from the app, things like that, or being able to reserve a time to come down to the bank for a specific appointment, it seems as though people are doing old things in new ways.
Yeah, I would agree. And another popular one amid the pandemic is you saw this flood of like new customers trying out digital for the first time. A very simple checking of the account balance to see, did this stimulus check hit? Because that was a lifeline for a lot of consumers.
Yep.
And you were seeing pretty widespread outages for a period of time. And behind the scenes, banks were really shifting priorities from let's roll out new flashy features to let's make sure that this is running effectively. Let's focus on error reduction, and let's also create education for this influx of new consumers. And another thing that's happened over the time period is, the lockdowns were really protracted. I was speaking with my team as we were initially going into the work from home environment, and we all made bets about how long this thing would last, when we would be back in the office. Somebody on my team made what seemed at a time like a laughably pessimistic prediction of like a few months out. And we were like, no way. Fast forward a year. Throughout that entire time period, the folks who have just picked up digital for the first time have had a lot of time for that habit to really set in. Yep. And that's why I don't think we're going to see a bounce back where Pandora goes back in the box, branches become number one again. This is the new status quo, at least for servicing interactions. The majority will remain digital, and that really leaves the long tail of customer interactions, upselling, customer service, that needs to be addressed and digitized for providers.
Yeah, let's place digital banking alongside some of those other more traditional use cases or activities, because we've got a chart here from Insider Intelligence, which basically takes all of our numbers, puts them side by side to look at American banking users by channel. So we're talking of adults here, over 18-year-old folks. So people with a bank account, 94% of American adults. Those that use digital banking, 73%. And then everything else behind digital banking, 71% of folks use an ATM, 68% use a branch, 55% use smartphone banking, which is digital, 30% call centers. So digital banking is already surpassed in terms of the number of people who use it, the number of people who use ATMs or branches, in fact. It's time now for the post-game report, where we summarize the key takeaways in 30 seconds. Dan, what is your takeaway from the show?
Yeah, I've just got one, and it's really quick, which is that branches aren't going to go the way of Blockbuster. So a lot of these sensationalist headlines, of course, are just that. But I do believe that we are headed for contraction. We are going to see year-over-year branch declines continue to accelerate, and that providers should plan accordingly.
That's what we've got time for this episode. Thank you so much to Dan for joining me.
Thanks for having me. It was a blast.
Absolutely, sir. Thank you to Victoria, who edits the show. Thanks to everyone listening. We'll see you guys tomorrow for the Behind the Numbers ad platform, hosted by our very own Nicole Perrin. She'll be speaking with Alex Cohn from the IAB Tech Lab.